Okay, guys, this is the beginner's guide video for reading the forecast. This is going to cover the estimated or exponential moving averages that are listed on the forecast. So, if you showed up in chat and followed, I probably sent you over to Discord or sent you the link for the beginner's guide for you to go through these videos so you can understand what's happening on the chart as it goes by. So I'm going to have a series of videos explaining all the indicators, how they work together. It is a one-click strategy. Then I'm going to have a summarized video for people who don't need the definitions and understand what basic indicators are. So for this is meant for somebody who is completely new to trading. They want to learn. They don't know where to start, and that's the kind of person that I've designed this one-click load strategy into NinjaTrader for. So here we are going to cover exponential or estimated moving average. On the forecast, you're going to have 5 of them that you need to know. The 20 EMA is the yellow dot dash. The 50 EMA is the orange dot dash. The yellow dot dash is the 200 EMA. And then you're going to have what I call a control EMA fast and a control EMA slow. I'm going to play a video that has a very good definition, explanation of what these are and how and where they're derived from. And then I'm going to click over and I'm going to cover how you read these on the chart as it goes by through the reading the forecast box on the left. So here's the video.
What is exponential moving average, EMA? Have you ever wondered how traders make sense of fluctuating stock prices? One of the tools they use is the exponential moving average. This method helps smooth out price data over a specific period, allowing for easier trend identification. Unlike a simple moving average, which gives equal weight to all data points, the exponential moving average places more emphasis on recent prices. This means that the most current data has a greater impact on the average, making it more responsive to new information. To calculate the exponential moving average, you need to determine the period you want to analyze, such as 10 days or 20 days. The formula involves taking the previous exponential moving average and applying a multiplier based on the chosen period. This multiplier is derived from the formula, 2 divided by the number of periods plus 1. For example, if you are calculating a 10-day exponential moving average, the multiplier would be 2 divided by 11, which equals approximately 0.18. You then take the most recent price, multiply it by this multiplier, and add it to the previous exponential moving average multiplied by 1 minus the multiplier. This process continues for each new price point, creating a smooth line that traders can use to make decisions. The exponential moving average is particularly useful in identifying trends and potential reversal points in the market. Traders often look for crossovers between the exponential moving average and the actual price or other moving averages to signal buy or sell opportunities. In summary, the exponential moving average is a powerful tool for traders, providing a clearer picture of price trends while reacting more swiftly to changes in the market. Understanding how to calculate and interpret this average can be a key component in developing effective trading strategies.
Okay, now that we understand what a exponential moving average is, or EMA, let's talk about how we read them on the strategy, okay? So right here, your control EMAs are the solid green and the solid red. And in reference to the reading the forecast box on the left, the forecast box was designed so that if you're working throughout the day, you can view this and know the condition of the chart without having to read and interpret the every line on the chart, okay? So when your control EMAs, when the fast is crossed and on top of the red, so the fast is the green, the slow is the red. When the green is above the red as far as price, that's a long condition. So the 20, the 50, and the 200 EMA, the price is currently above all three of those. That means we're in a long condition. So when a trade is about to be executed, we're looking for the EMA cross as our entry point. So as the forecast cloud turns from red to green, you see the transition here, the control EMAs will cross, and on the next candle would be your entry. So they crossed on this candle, and you want to make sure you confirm that the signal is good. On the next candle you would enter. So you would have entered somewhere on this candle after the control EMA cross, and you would be in a long. And the long on this particular trade went all the way to 24,978. So you would look for you would look to the regular EMAs for an exit point. So at the 20 EMA, which is the yellow, or the 50 EMA, you would set your stop loss here. So it would have executed the trade, it would have topped out, and the price came back into your EMAs, the 20 EMA or the 50 EMA. So this is where you would have exited the trade. So you would have exited the trade somewhere around 24,873 based off those EMAs, and you would have entered the trade somewhere on this candle, which is 24,826. So 24,826. So somewhere in the middle of this candle, we'll call it 24,830. So you would have entered at about 24,830, and the first time you're using the regular EMAs, the 20, the 50, and the 200 as points of resistance or support. And you would, if you would have been sitting on the 50 EMA, you would have exited somewhere around 2872, which would have been a 40-point trade on this scenario. So that's how we use the EMAs to enter and exit, and to track our points of resistance, which I'll go over more in another video. Okay, so if you have any questions on how this works, just drop into the stream. Ask questions. This is my first draft of the video, so somebody who's new, if there's something in here that you don't understand and watch, kind of explain it to me and I can go back and I'll edit the video, but please stop into chat in the stream. But remember, I do work all day long. This is for us grinding out the daily grind, either working for working for the man in the corporate world, or just trying to take care of our families, and we're trying to figure out a way to make some extra money on the side with our spare change. And that's what I'm here for. So just remember, if I don't answer right away, give me a second, or if you hit me on Discord, I'll get to you as soon as I can. And I'll make sure that you understand. But this is your entry point. For the short, it would be in reverse. So when the short occurred, the short cross was right here. Okay. So your short was right here. You would have entered somewhere on this candle. And then you would have got out somewhere. You would have entered somewhere on this candle, somewhere right around 24.19, 8.19, 24.820. And once you cross the VWAP, I probably would have had, we'll go over the VWAP, but here's the 200 EMA. Once you tag the 200 EMA, you would have moved the stop, you would have moved your stop back up to protect that. And then once you came back through, you'd be looking to set up to go the other way. So that would have been 712, 712 entries somewhere right around the 50 EMA. Damn, is that right? That's a good trade. That's a 90-point trade. You know, you just get in on the next candle after the cross, and then when you cross the furthest EMA out on the chart, you would adjust your stop to protect this EMA. Now, if we continued lower, that's great, but if you come back, that would have been the end of the trade after we cross this EMA. So that's basic EMAs, how to use them in the forecast, and how to read them in the box. All right, so that's it for this video. I'm going to cover VWAP in the next. Thank you, and just stop by chat.